Hey there, it's Tiana with True Financial Services coming at you with your true tip of the day. Today we are talking about PITI, the acronym PITI, which stands for Principal, Interest, Taxes, and Insurance. And we're dissecting what that means. So when you make a payment, your payment, when it's fully amortized, includes both principal and interest. Principal is the amount that helps to pay down the actual loan, and interest being what is actually paid to the bank. So the interest rate that you received when you locked at the very beginning. And oftentimes it will take, depending on the loan program and the loan amount, it will often take, and the term actually, it will typically on a 30-year term, it's going to take at least 8 to 10 years before you start to see the reverse effect where you're paying more in principal than interest. And even that can change based on how you're making your payments. So you may end up putting, an additional $100 a month towards your principal, or maybe there's a bonus received at the end of the year and you want to apply that to principal. So that will start to pay down the principal faster, and you'll get to be paying down principal faster than interest. Hopefully that makes sense. And then insurance, we base the insurance calculation, standard industry-wide, is 0.3%. Now that can vary. That's usually when we're giving you an estimate or a quote. So we won't know until we actually receive the insurance quote, the premium from your insurance carrier. And oftentimes we refer folks over to their existing insurance holders. So who might be currently carrying your policy for auto insurance, or if you have recreational vehicles, or if you're renting. So oftentimes there's discounts, or you're grandfathered into certain insurance companies, so you'd want to check with them first. And then you may ask your loan officer or someone else for a referral on which insurance carriers, because depending on the location, sometimes people are in a flood zone, or sometimes they are in high severe fire areas, and you might have to check with multiple insurance carriers. And then in terms of taxes, the standard rate that we use in San Diego is 1.25%. So 1.25% is the standard rate we use. However, based on your location, if it's new construction, if streets had to be paved, if there's a school in the area, all of those things factor into what your tax rate is. So some folks would have Melrose, and oftentimes Melrose is tied to new construction or a completely new development in which they're building out infrastructure in that development, which could include parks, walkways, like I mentioned, schools, things like that. So you'd want to check with the builder or your agent or loan officer what that tax rate is in the area, because it can exceed 1.25%. And then you'd want to know that because it's obviously factored into your payment. So that is your true tip of the day.